If Trump does nothing, he saves the American economy 1.38 trillion. If he starts to peel these back and starts to pull back some regulations and free up the business community from 260 million hours of paperwork in one round of legislation, if he can peel those back, that goes straight back into the economy. Deregulation. That's the first Trump opportunity in a big way. Some of the most interesting things I'm seeing in the news: Colombia versus Trump. Colombia versus Trump. This one is interesting. If you've tuned into webinars with us in the past, you know that I'm not fully on board with the idea of tariffs and being applied in so many different circumstances. There's a risk of inflation, increased price on all kinds of goods to consumers. But the Colombia versus Trump situation, extremely interesting, where the Colombian president rejected a plane full of immigrants that had made their way to the United States, not legally, and rejected them. And Trump threatened to place a tariff on Colombian goods entering the country. So this is one good case study early on in the Trump presidency of what the impact of tariffs could be. See, Colombia to the United States represents less than 1% of GDP to us as Americans, of our GDP, of our economy. But to Colombia, we represent about 26% of their GDP. So in that case, if we start throwing around 25% increases on different tariff goods coming in from Colombia, what's the impact on their economy? Well, massive. So it was a smart move on Trump's part. I mean, it was tense with the Colombian president there, but we're seeing an early case study for how tariffs could be used in a strategic way that actually benefits the goals of the United States, regardless of your thoughts on immigration. That's a whole different discussion, but interesting to say the least there. Let's get into it. So we always, on any presentation, we always want to set the tone for what we're doing. First things first, we're going to tell you what we're going to cover today. We will be covering the overall goal of analyzing how the most savvy investors in the market today will be making a killing, the strategies that they're utilizing, what numbers that they're looking at, the massive shifts in economic trends that are taking shape in 2025. Also, we'll look in the rearview mirror for 2024, how we're getting to these massive economic shifts and trends. We're going to go over exclusive insights into the trajectory of real estate, what we expect to see moving forward. We'll talk about all-weather portfolios, a fantastic topic for what strategies we're seeing really the best and the brightest using right now. And last but not least, we will be going through the exact playbook of what we have gone through with not just our investment committee and our advisory committee, with kind of the best and brightest minds of what we're seeing at Saint and next steps we're taking, but we're going to share that all with you and go through the details here. So before we get too far, I want to introduce myself, just so you know who I am. And, I'm seeing a lot more people pile in. If you're just joining us, let us know where you're joining in from. We always like to see where our audience is tuning in from. My name, in case we haven't met, my name is Nick D'Angelo. I'm president and founder at Saint Investment Group. I'm blessed and honored to be recognized as a thought leader in the real estate and investment space. I get to appear year-round on podcasts or on stages. We just started hosting these webinars early last year. So this is a newer product, newer content piece, newer outlet for us to connect with our audience. I'm proud to say that our investments over our career here have had some really impressive, really good performance over the period of time. I'll show you a brag slide up next. But currently in the portfolio, we have over 500 mortgages in over 21 states. That is growing consistently. Over 206 million in assets under management. And we're proud to say that the upper returns that we return is 12 to 14.28% in a fixed income fund. So you don't see that often. We're very proud of that. And I mean, really, my favorite piece about this is that we've never missed a distribution to our investors, and that's been for over a decade. So we like to say always on time, every time. Your money's safe with Saint. And here's the brag slide I was talking about. I love this slide. Over 7 successful exits, we've averaged 35.5% returns. We've distributed over 13 million to investors, over 206 million in assets under management, over a decade of consistent on-time distributions to our investors. So this is my favorite one, by the way. Right here is that all the good returns aside, the huge amount of money we've distributed, our amazing investment community, it's that we've been on time every time. In rocky markets, that's something we can be really proud of. But don't take our word for it. Don't take our word for it. Of course, we think we're great, but we also always recommend people to check us out, whether that means our Trustpilot page or our Google reviews page, or take a Google search and go find stuff about us online, or check out our website. We compile our testimonials in an entire section on the Saint Investment website. Highly encouraged. Highly recommended to check that out. Here's a few amazing people. Richard Fong, founder and CEO of Bliss Drive. Clint Lauren, CEO at JC Motors. Billy Kim, CEO of MIK Construction. Amazing individuals. Can't say enough good things about our community. Also, last quick item, and I said this at the beginning, but we have a lot of new people piling in. Our YouTube channel is the best opportunity. If you want to see things we go through today in an expanded format, we try to condense this. We want to make sure that these webinars are a reasonable amount of time. But if you want the real meat and potatoes, where we go through the most ultimate deep dive of everything that we're doing, you've got to check out our YouTube channel. Here is a link here to the YouTube channel. You can check out the long form content where we go slide by slide. I mean, 20% of this isn't even included today. And that's just too damn bad because there's so much good information. But again, I highly, highly, highly encourage you guys to check that out as well, and see all the content we put out there, because it's really kind of the full scope. Just to make sure you have the information at your disposal, this is a little bit about our income fund. We pay fixed returns on a monthly basis with very flexible investment options. We pay up to 14.28% returns. So if over the course of this presentation, over the course of this webinar, you're curious, Ange, do you mind dropping in the link to the calendar? Y'all can sign up for the calendar. You can put a time in the calendar to learn more about what Saint Income Fund, what it's made up of, the assets, our strategy, our thesis. You'll see a lot of that in this presentation. But if you want to learn more, if you want to connect with us and get involved in the Saint Income Fund, you see the calendar link. It just dropped in the chat, and you can check that out. All right, so quick outline here. We're going to jump into a legal disclaimer. We're going to keep our attorneys happy as always. Then we're going to jump into the topic. It's an amazing topic. Today's is particularly dense, although they all kind of are. Today's is particularly dense, a lot to cover. Then we're going to go through some quick housekeeping, a couple announcements and items for y'all, and then Q&A. This is easily the most unexpected, wildly beneficial piece of this whole thing. I thought people would get the most out of the presentations. We get amazing reviews at what we present, but the Q&A always has great discussions, lots of high-level insights, people comparing notes back and forth, dropping links, asking great questions. I encourage you to do the same. It's a great opportunity to bring our investment community together and compare notes so we all come out the other side more engaging, more intelligent, more educated. So Q&A at the end, it's going to be great. So quick word from our legal team. I encourage you to read this, but the top notes here, this is not investment advice. This is for educational purposes only. Basically, these are the things that we have found. We do a ton of research, a ton of data deep dives, and this is our findings there. We're presenting these to you guys. Last but not least, all investments carry risk. Past performance does not ensure future results. Oh my gosh, this is something newer we've been doing. We have a lot of great engagement. We have a lot of people that jump in and ask questions or comments and great things. Not only that, we want to encourage even more. So, in order to do that, we already wanted to give a giveaway on the webinars. Today's giveaway is a book titled Mastering the Market Cycle by none other than genius, lifelong investor, Hall of Fame investment advisor and strategist Howard Marks. We debated not including this because it's really high level. I mean, it's really, really, really portfolio management, huge level strategy of investing, but I can't recommend it enough. You're going to see charts and graphs in this presentation that are exactly what he goes through in this book here. So we included a link. If you just want to buy the freaking book, I encourage you to do it, but we would love to send you a copy. We would love to send you a copy. So ways that you can get a free copy here. The best engagers, the best people that engage with what we're doing today will get a copy of this book. Ways that you can engage. Comments in the chat, questions in the chat, responding to the polls that we dropped. You can see we have investing goals poll. That's the current poll that's up now. So comments, questions, polls, and then last but not least, leaving a review on our Trustpilot. So we get a ton of great reviews on Trustpilot. It's a great way for other people to see the great things we're doing and to bring them into this ecosphere and this ecosystem where we can all continue to grow this and learn together and have even better discussions and better topics catered to what's best for you guys. So Ange, could we drop a link to our Trustpilot in the chat also so that everybody has a link to that? Comments, questions, polls, and reviews. If you're one of the best engagers, we will send books. There's not a set number. We send out a whole bunch of them. We can't wait to send these to you guys, especially when it's a book as good as this book by Howard Marks. So let's kick this off, guys. Let's have some fun. First things first, let's talk about a topic that's on top of a lot of people's minds. It is inflation and interest rates. There's a big interplay between the two. Let's jump in. So first things first, we're going to look at the history of what inflation looked like throughout 2024. As you can see, also, Ange, can you guys see my cursor? I always like to double check. You can see my mouse, right?
Yep, we can see it perfectly.
Perfect. Okay. You can see last year. You can see 2024 here, guys. You can see that there were some highs and lows. Mid-year, it looked like it started to get under control. If you recall, we started to have some rate cuts towards the end of the year. We had 3 rate cuts, a 50 basis point, a 25, and a 25. And pretty quickly, inflation started to tick up. Now, as you know, more than likely, the Federal Reserve has an inflation target. So they don't do it willy-nilly. They're not out there, unclear on what their goals are. Their goal is 2% inflation. They want to be right about there. Jerome Powell is an attorney. He's not an economist. So when he says 2% inflation, he means it. This is the most updated way to track inflation based on what's called personal consumption expenditures. It used to be CPI. We've shifted to PCE, which is what the Federal Reserve looks at for their inflation data. Okay. Core PCE 2023 was about 2.8% year over year at the end of December. So, I mean, you can see where we really took kind of a big jump. Right here, we had the COVID era. We printed record money in a short period of time. The PCE only topped out at 5.9. But just as a side note, CPI, which many people still look at, I still look at quite a bit for inflation. Well, that was at 9.1, middle of 2022. So we see a huge spike. It dropped back down. And that's kind of the story of the last, decade of rates here, of inflation here. So interest rates. The Federal Reserve implemented significant changes to monetary policy in 2024. What were those? Well, rate cuts. After the steepest period of rate hikes in history, which we saw right after Janet Yellen said, remember, she said, inflation is transitory. And then it went all the way up to 9.1%, right? We then saw the steepest rate hikes in history. Now the Federal Reserve has been peeling off on that. We saw some cuts. That is what we're talking about when we say significant changes to monetary policy in 2024. So we did see signs of cooling on inflation, but still we saw towards the end of the year jump. Labor market. So the Federal Reserve has what's called a dual mandate, meaning there's two things that they are mandated to balance the performance of. On one hand, we have inflation, target is 2%. On the other hand, we have unemployment, managing the employment side. Unemployment target is around 4% today for their mandate. So keep in mind when we go through labor, what the goal of the Federal Reserve is, what their mandate and targets are there. This is a good breakdown showing where we were of the federal funds rate. This is their internal rate of the Federal Reserve. First, we see a 50 basis point cut, then a 25 and a 25. We saw 3 cuts in 2024. That's peculiar because if you were tracking Wall Street, which is very outspoken on how sure they are of every prediction that they make, Wall Street predicted 6 cuts for 2024. We got 3. Wall Street predicted a lot last year that was incorrect, but they got half the cuts they were expecting, and we saw inflation spike nearly immediately around this period of time. So we can take away that inflation is stickier. Wall Street continues to be wrong at least 50% of the time, and we know that inflation is very sensitive to these rate cuts. Implication. So here's a good one. GDP growth trajectory projected at 2.1% for 2025. So throughout this presentation, we're going to tell you where we're at today, how we got here today, and then also what we expect in the future. This is what we expect in the future. And you'll see a poll pop up here. You're going to see our 2025 interest rate poll. We want to know what you guys think is going to happen over the next year for interest rates. They impact so much of what we're doing in all aspects, business, cars, even dental insurance, or dental, all kinds of stuff. Most importantly for us, we're real estate people. We're real estate investors. So rates are very important to how we approach investments and strategies. The growth and the big takeaway on growth here is that 2.1% is actually above trend growth. Let me highlight that for you a different way. We are beating expectations of our GDP in 2025. We are projected above what the trend looks like. That's positive. That's a positive expectation. So also what we expect for 2025, the Fed has pulled back, guys. The Fed has pulled back. Their initial expectation and what they were putting on their dot plot. If you ever want to see what the Federal Reserve's planning, it's called the Federal Reserve dot plot. It is a literal map of a timeline showing what they expect on the Federal Open Market Committee, what they expect rates to be in a year, 2 years, etc. Originally, they were planning on a 1% reduction, aka 100 basis points. Now what we're looking at here is 2 cuts at 25 basis points each, totaling 0.5% or 50 basis points throughout all of 2025. They have cut their rate cuts in half. What they want to end at is a federal funds target rate of 3.75 to 4%. Roughly, us as consumers, us as the people that are affected by rates, we can add roughly 2% onto this. So when you go buy a mortgage, you should see about a 5.75 to a 6%. If you use this as a foundation, that's usually where it shakes out. So slower rate cuts because inflation jumped up immediately and Donald Trump's policies could influence inflation significantly, but we'll get to that in a second. Before we get too far, we talked about rates. Let's talk about some drivers and some parallels to rates in the United States. So 10-year Treasury. This is an important item to track. For the first half of 2024, we started off at 3.9. We jumped all the way up to 4.7. That's right here. Then we had a really rocky second half of the year. All over the place. Turbulence all the way down to 3.7 at one point, and then all the way back up. So Why do we talk about 10-year treasuries? Well, I can tell you it's not for the 4.5% return. Okay. I mean, generally speaking, if you're good with 4.5% return, then that's okay. And then this slide's really important to you for your return profile. Our investors at Saint typically are not interested in 4.5% returns because typically the discussion we have is, hey, if inflation's at, let's say, 2.5, 2.6, and the 10-year treasury's at 4.6, then roughly you're lucky to have a 2% net return on that. For our guys, that's cutting it too close. Our investors typically are not looking to 10-year treasuries for yields and returns. More importantly, sophisticated investors that are interested in real estate are looking at 10-year treasuries because they correlate. They often are parallel with interest rates. Okay. Especially single family, but really all of real estate. So if you take another way to put this, if you take this exact chart here, big dip, big increase, and you overlay mortgage rates, it will be very similar. That's my point here. So 10-year treasuries, the third piece to it is that the Federal Reserve, you know how they cut rates with the expectation that rates will go down for the consumer? That didn't happen. That didn't happen. So the question is, why didn't that happen? Well, it's because the freaking treasury didn't go down. When they cut rates, we did not see the expected change in treasuries. So in this case, the Federal Reserve, if this trend were to stay, the Federal Reserve loses a powerful lever that if they reduce rates on their side, they're not seeing mortgage rates impacted immediately. That's concerning. So contributing factors to the 10-year treasury. The first, and simply put, is the Federal Reserve's monetary policy adjustments, aka the different decisions that they're making internally at the Federal Open Market Committee, the FOMC. We're seeing persistent inflation concerns. We've talked about it. Strong labor market conditions. That's interesting. That's interesting, right? Another driver of inflation there. We'll get to that too. Robust services, growing government borrowing needs. Now, I won't over drill down on this. If you guys want to understand the line by line balance sheet of the US government, exactly where the debt goes, exactly how much we're paying, aka 1 trillion a year in interest on our 36 trillion in debt, we have something called the Great Melt Up. It's a webinar we did previously. Highly encourage you guys to check that out. Either hit Luke up with the call link or go to our YouTube and check that out. It will break this entire government borrowing issue down into the nitty gritty. So the real question is, where do we go from here on the 10-year treasury yield? Well, I told you we'll make some projections here. This is what the big boys are projecting for 2025. We'll start with investment banks. Again, they can be a little rosier, right? They can be a little rosier, sometimes too rosy, like Wall Street in 2024. But we're seeing Deutsche Bank's the outstanding. They're kind of the outlier, but more or less, let's say 4-ish% is where everyone's landing for their expectations of the 10-year treasury. So it goes down 0.5% is what they're saying. So if you apply that to mortgages, then these individuals would say roughly mortgages to us as the consumers would be impacted by about 0.5%. Consensus forecasts, if you take a broader net. You have Wall Street, bank rate, base case. They all are relatively in the fours. Let's say four. I mean, really, yeah, like 4.25, up to 4.5-ish, depending on the way what you're looking here. So that's the projections for 2025. Let's say low fours for the 10-year treasury. So not a lot of movement in mortgages, unfortunately, according to these experts and their projections. 30-year mortgage rates, 30-year fixed mortgage rates. So here's the breakdown of all of 2024. If you want to skip to the end and kind of read the back of the book here, we ended right about 7%. So we started about 6.6 and we ended about 6.7. There was some turbulence, right? We saw rates go all the way down to, in September, we saw 6.18, I guess, the peak being 7.06 in May. Roughly, we're in the range of the high sixes. Pretty stable, right? If we look at the previous chart, We don't expect a lot of movement, especially according to the 10-year Treasury. But let's look in context. The historical context here, we haven't had these kind of interest rates in a very long time. But the good news, we're well below the average since 1971. The average since 1971, 7.72%. Why is 1971 important? Because that's the year we got off the gold standard. So we really moved to a true fiat currency. Fiat currency has pros and cons. The cons are that you can basically inflate it and debase the currency dramatically. The pros are we have a little more control over it. But this is the average rate since 1971. So projections, what do we think are going to happen with mortgage rates for us, the consumers, the people in the market? Well, if you look at Fannie Mae, they expect rates to remain above 6%. Their shot in the dark is 6.3. Okay. MBA, which is Mortgage Bankers Association, is 6.4 to 6.6. I mean, right in the same range. The real interesting point here is right here. It's this note. This appears to be a new normal. Now, we talked about since 1971, the average mortgage rate is about 7.72%. If you go back about 100 years, the average mortgage rate over the last 100 years is roughly 6%. So if you look at these details here and you look at the projections and you look at the forecasts, like about 10 years out, we are looking at a situation where 6-ish% mortgage rates are probably the new norm. And while that, that's shocking to us who are used to the 3s and 4s%, the reality is this is kind of a return to norm over the last 100 years. I mean, this is below norm for the last 50 years, but for the last 100 years, all day long. All right, we're going to shift. Labor market. So we talked rates, which is one half of the Federal Reserve's mandate. Let's talk labor, the other half of what the Federal Reserve is focused on. Lots of good data on this slide. This one's interesting. Men earned 1,200-ish, women earned 1,000-ish. I'm hoping that's because maybe men are taking more risky jobs or working the night shift more or something, but beyond the scope of this, the biggest takeaway on this slide is that average base salary went up 3.8% in 2024. I love to see this. This is a win. Let me tell you why. Because inflation was below 3.8%. Okay? So base salary increase was 3.8% in 2024. Inflation was in the twos. Okay? So anytime we see base salary increase at a higher, faster rate than inflation, that's a win for the American people. That means the benefit to the American people of being able to afford their lives better, pay for their expenses better. These are good things. And look, I make no endorsement to either candidate for presidency. That is beyond the scope of this, but this is why voting matters. I'm an economic voter. I vote for whoever I think is going to be a better president for the economy, because things like this, they matter. And when people say, hey, the economy's crushing me, it's because their cost of living is increasing beyond their base salary. So I love to see this in 2024. This is a positive trend. Wages and salaries, here's a different breakdown, okay? Salary increases have remained above pre-pandemic norms of 3%. We see that. That's good. This is a positive situation. Labor supply constraints continue to drive wage pressures. Okay, we're not going to go off on a tangent. We also have a webinar on this. But anyways, the long story short is demographic changes in the US drive a lot of what we're looking at here. We have the baby boomers, which is the largest and also the most wealthy generation of all time. They are aging out of the workforce. They are retiring. Replacing them at the bottom of the workforce, the youngest of the workforce, is Gen Z. Gen Z is the smallest generation we've had in a lot of generations. Gen Z also has the lowest labor participation rate of any generation. That's not uncommon. Every generation wants to work less, apparently, in the United States. But Gen Z takes the cake, okay? You have big generation leaving the workforce. You have small generation joining the workforce. So we have a condensing workforce. Okay. That means that the less amount of people get to demand higher wages typically. So you see an upward pressure on rates, or excuse me, on wages. So that's what we're seeing there. Real wage gains expected as inflation moderates. That means slow that freaking inflation down so people can make some money beyond what inflation is taking away. So what do we forecast? Well, you can kind of take a look. I don't love this. Should we all do we all need government jobs? Is that's kind of the real question of the slide. Should we shift to working for the government? Quick note, the US government is the biggest employer in the United States is the United States government. 20 million jobs. Just, you know, file that somewhere. Um, Unemployment rate. Okay. So this is the other half of the dual mandate of the Federal Reserve. This is a great chart. 2024 started with 3.8, but that's not the whole story. Really, the story starts in 2022. We're at about 3.5% unemployment. That's very competitive. That's very competitive. We're happy with that. We ended the year of 2024 at 4.1%. Okay. So we're going the wrong direction on unemployment, simply put. Wages are going up. That's good, but unemployment seems to be climbing. If you were to ask me, I've never been on the Federal Open Market Committee. I'm not part of the Federal Reserve. But if I was to bet of what they're looking at and they're scratching their heads, it's the fact that unemployment's going up, but so is inflation. There's something called the Phillips curve, okay? And what the Phillips curve is the idea that consistently you see employment and inflation as counterbalances. So what you see is if unemployment goes up, inflation goes down, and vice versa. In this case, the Federal Reserve has their work cut out for them because they have inflation going up. And I know I am talking a little dorky, but I'm going on inside baseball so you guys know. Very rarely do you see unemployment and inflation rise. That's the takeaway here. Here's some long-term trends of key statistics and in the labor markets here. You'll see we had roughly a 5% unemployment in 2006. You can see 2008, boom, things blew up, going downhill, huge spike, COVID, modulating, getting back into, some good territory here. Good territory here, and then an upward curve, which is what we were just looking at the last few years. So historical context, there's this funny thing in the United States where we think yesterday's always better than today, where just the golden years of the US are behind us, right? I'm here to show you that that's not always the case. In 1948, the unemployment rate was 5.68%. So even though unemployment has gone up over the last year to 4.1%, we're still way below, some of the more difficult times in American history with employment. The current rate that we have today remains near historical lows. So that's the broader context of the discussion. So where are we going? What projections are we seeing in 2025? I'm going to let you guys digest this for 1 second. Okay. So if you look at the average of what people are expecting, kind of the big companies, you look at Vanguard, universities, Goldman Sachs, investment banks, et cetera, the range for the top 10 and bottom 10 averages is 4.5 to 4. 4.3 is about average. That's what we're expecting. So what does that mean? It means we're at 4.1-ish today. By the end of next year, we are expecting, per the biggest and brightest minds, Wall Street and a lot of investment, we'll land it right in the middle, 4.3. We're on the way up, is what that means. But there's still some good news, because the full year GDP growth for 2024, 2.7%. That is positive. That shows resilience. That shows us having great GDP growth, even with inflation and even with rising unemployment. That's a positive statistic for the United States, something that we can hang our hat on. Interestingly enough, consumer spending remained strong. 78% of our GDP in last year was from consumer spending. That means optimism. That means our country has money. That means they're spending it actively into the economy. And then here's something interesting. The growth of the United States exceeded nearly all, or no, it exceeded all other G7 nations since 2019. In other words, we're carrying the G7. We love our allies. God bless them, but they need to step it up because really we're carrying the G7. We're carrying NATO, Europe at this point. So we really need them to be strong, but we also are showing our own strength of how resilient our country is at this time. Some GDP growth projections. So quick overview, you'll see a couple different ones. Goldman Sachs, the outlier with that 2.5, good number. All right, so let's shift gears. A lot to get through, but this section is critical. This section is critical. New technologies, the US has been a leader in for some time. We lean into new technologies heavily, and this is an opportunity to take something to a whole new level, to exponentially grow a sector and really all sectors. So we saw AI burst onto the scene 2 years ago with really, really huge advancements that have made, massive strides even in the last 2 years. Advanced modeling, text to video, sophisticated interactive back and forth with AI technologies. But this right here, I believe, is one of the most landmark moments in technology history. I don't know how to say this any more clearly. In 2024, we saw OpenAI's model achieve an IQ score of 120. This did not make headlines enough as it should have. 120 outperforms the average human today. So the discussion has changed completely. We're no longer in a world of someday AI is going to outperform humans. That's already happened. That was last year. Now the question is, where do we go from here? Where's the future of AI that's already smarter than, look at this, 91% of the population, right? So this is the big question that requires answering. Can it be used for good? Can it be used for bad? All of the above is the answer. But the bigger question is, where does the road lead ahead? Here's some analysis of it. 88% of organizations actively use AI applications in day-to-day business. I think this is incredibly important. We see some sizes of the markets. I don't know. I would say that I think these are probably undervalued on those numbers, but those are the numbers today. What we're seeing is AI is an essential tool for businesses across the board. So what do we think is going to happen with AI in 2025 and beyond? This is a big question. The real question that I have personally on this, it's right here. It's not just AI, which is now smarter than the average human, or 91% of humans. It's what happens when AI starts meeting robotics, space, healthcare. The breakthroughs here really, this shatters the ceiling, right? So the question is, how do we harness this? How do we maximize this? How do we as a country be at the forefront of something like AI when we know how much potential it already has? I love this. Again, I'm an economic voter. I love geopolitics, so I geek out on stuff like this. AI could increase the world's GDP by 14%. Staggering. Staggering. Some good quotes, some good analysis. Okay. We're going to shift gears to the economy under Trump specifically. Why? Because there's so many changes on the horizon. There's so many big discussions happening. And the first thing that I'm going to lean into here is what I believe are the top 3 opportunities for President Trump. Whether you love him, whether you hate him, that is not the discussion here. This is an economic discussion. So the discussion we're having, the top 3 things that Trump has an opportunity for that he has already talked about. So these aren't me pulling it out of a hat. These are things, these are priorities that he said. He said a lot of different things, but these are three that really, truly, I don't want to waste words here, could revolutionize and grow the US. I mean, we could enter a golden age if he did any of these three at scale. Number one is deregulation. Number two is balancing the federal budget. Number three is growing manufacturing in the United States. So deregulation, balancing the budget, and building out manufacturing on US soil. I'm going to add an asterisk here to solving inflation. Why do I add an asterisk? Is because the first three are highly inflationary, ridiculously inflationary. So the reality is it's probably, I don't know, I see it as basically impossible to control inflation if he's really leaning into the other items. But still, that would be my little asterisk. Number one, deregulation. There was a study completed last year, 2024, by a group called the American Action Forum. Okay. What this study included was calculations of total costs of rules by the last three presidential administrations. Okay. It calculated two ways of costs. One is just the physical dollar cost that it cost the business community and the American people and the economy. Number two is it calculated the amount of paperwork hours that each president cost the American economy and the business community. Mind blowing. Okay. I'm shocked that they could really compile this data. Let's start with Obama. Obama, with his regulations, cost the American economy $1.1 trillion. Okay. Shocking number. That's an economy. That's straight up GDP. Just pulling that off the GDP. In paperwork hours, Obama's regulation policies cost the American people 240 million paperwork hours, shuffling papers back and forth, applying for approvals from the government, trying to compliance across the board, 240 million hours. Now, I give Obama a pass. Switcheroo, I give Obama a pass. Why? Because he had the global financial crisis and the recession. Okay. Our country, in case we all forgot, the GFC, the global financial crisis in 2008, almost crushed our entire financial system. Okay. So yes, Obama regulated the crap out of, all kinds of industries. Mortgages dealt with Dodd-Frank. Banking had all kinds of regulations. You had the comptroller of currencies line by lining everything at every freaking bank in the country. Massive bank failures. Lehman Brothers. I mean, so not to underscore too much, but huge amounts of regulation that were added. Many of it was in the wake of a financial crisis. Then you had Trump. Trump, in contrast, his regulations added, so additional to Obama's, cost the American people $25 billion in time and efforts and energies towards that. So the next is Trump's new policies cost the American people 60 million paperwork hours for compliance, regulation, et cetera, et cetera. Now, that's pretty low compared to Biden, or excuse me, that's pretty low compared to Obama, right? We're talking a sliver of Obama's. Here's the bad one, Biden. And again, I don't want to overbeat up on Joey B. Okay, Joe Biden. There were things I agreed with, but this is one of the most ridiculous. I will say that. Joseph Biden, Joey B, cost the American economy, the American GDP, he cost $1.38 trillion. He beat Obama by his added regulation, additional regulations that he added to the American people, to the business community, in addition to 260 million hours of paperwork that people in the business community, businesses had to do for compliance, regulation, et cetera. Okay. You can say, well, he had COVID during his term. So did Trump, right? And Trump's numbers are far below this. And again, I don't disagree with everything Biden did. We'll get into some things I agree with, some CHIPS Act stuff, some foreign policy, et cetera. But he really dropped the ball on this piece. So deregulation, a Trump opportunity. If Trump can peel these back, if Trump does nothing, he saves the American economy 1.38 trillion. If he starts to peel these back and starts to pull back some regulations and free up the business community from 260 million hours of paperwork in one round of legislation. If he can peel those back, that goes straight back into the economy. Okay. So instead of 260 million hours on paperwork, now businesses are doing that on customer service, research and development, investment, growing their businesses. That goes straight to the top line of the economy. This is a huge opportunity not to be missed. Deregulation. That's the first Trump opportunity. Next, number two is balancing the budget. If Trump can stick to any of his claims of balancing the budget, he will have a huge opportunity to revamp the economy in the United States. We currently have an average per year deficit of $2 trillion. We currently pay a $1 trillion amount of interest per year being added. We currently have 36 trillion in debt for our country. These are unsustainable. Both sides of the aisle know this. They just don't like to talk about it. Okay. Trump has said he's going to enact Doge, and Doge is going to make some deep cuts. That has become a political statement, but I'm going to stay away from the political side and stick to the point that someone's got to do this. If Trump sticks to his guns and he gets this done, he removes regulation to boom that GDP and get that, get our economy going. And he removes a lot of this government spending and reduces the deficit that we're in. And he can get those tightened up. We're hitting it from both angles, improving the economy by growing it and reducing spending. We're getting closer there. The last piece, manufacturing in the United States. Trump and Biden, to his credit, I'll beat up him on one side, but I'll give him credit on the other. If we can bring manufacturing back to the United States, which basically every political candidate and two presidents have now, shot for, we can absolutely boom the economy dramatically. I'll show you some numbers, some cheat codes on that of what we're looking at there. But those three, deregulation, balancing the budget, and manufacturing, we would blow up our economy to levels we've never seen, and we would reduce spending and give future generations a balanced budget in a big way. Let's start with what we possibly can do to bring manufacturing and to bring industry back home. So the CHIPS Act, what was it? The CHIPS Act is a $280 billion spending package over 10 years, which includes research and development and $53 billion for specifically the manufacturing sector. This is very good, okay? It's designed to boost especially semiconductor research and development and manufacturing in the United States, but it also promotes a lot of different manufacturing in the states as well. Now, just like every political party, Trump disagreed with this at first, saying, hey, I criticized the CHIPS Act. It's flawed. It's, et cetera, et cetera. There's better ways to do this. But Howard Lutnick, who's the incoming commerce secretary for the Trump administration, he doesn't hate it so much. Looks like it's going to continue for the period of time. This isn't so dissimilar to when Biden came into office and saying, hey, Trump, he's so bad. He's wrong about China. He's wrong about how he treats our allies. But then he didn't really change NAFTA 2 or any of the other tariffs that Trump enacted in his first time around. So both sides are jockeying. This is more about political appearance than it is disagreement. So I believe the CHIPS Act is good. I give kudos to Biden for the idea here, and I believe this is here to stay. That's a positive thing. $53 billion for manufacturing back in the States, in addition to $280 billion for a total spending package. So manufacturing in the United States, we touched on one angle, but what we do know about Trump is that he wants to bring this back to the US, right? Made in America, that's, a big, big focus of the Trump administration. This will include, his goals are tax incentives, tariffs, and deregulation. Okay? Tariffs, I was staunchly against them, but if you apply tariffs to other countries, it makes their goods and services more expensive when they come into the US and provides a little breathing room for American companies to build out. So that's kind of the idea here of protecting American business through tariffs, something interesting. Let's talk growth. Similar to the CHIPS Act, which is focused on growing industry within the United States, we're circling back to AI, but in the section of Trump here. Why? Because they intersect well to understand this. This is one of the early, most positive signs of the Trump administration. Project or Stargate project, okay? This is a project that brings together the White House. Trump and the White House are bringing together Sam Altman from OpenAI, Larry Ellison from Oracle, and Masayoshi Son from SoftBank. Big, huge, massive names in the tech space. This is a $500 billion project to master AI in the United States. The goal is that at the end of this 5-year period, that we are the world leader, no holds barred, no question. We are crushing the rest of the world in AI. I love the world. I have family overseas. I'm an American citizen, and I want America to absolutely be the shining star in the entire world. I love this project. I love this project. This is clearly 100% the largest AI infrastructure project in human history. So all eyes are here. There's huge questions about how the energy to support this is going to be implemented, but the point is that the government is rightfully focusing on the power of AI here, and they're bringing together the biggest names. All right, my favorite section, guys. You ready? Real estate market. This is my favorite. I'm going to pause here on this. Well, I'll pause in 1 second. These are the sectors we're going to cover here. Single family, multifamily, office, retail, industrial. We are going to start and end. We're going to bookend this with 2 of my favorite asset classes in the history of real estate. So before we get too far, here are some stats. All the stuff you hear in the news, all the things that you hear and you read in the headlines, we're going to dive deep so that you get the inside scoop. Here's one to set the table. 70% of CRE, commercial real estate investors, expect to buy more assets in 2025 than in 2024. That's about as optimistic as you can possibly get, right? In order to drill down on why that optimism's there, we're going to cover a few things in each asset class. We're going to cover what stage of the market cycle each asset class is in, because they don't move synonymously. They don't move at the same pace. Each one has different drivers. So what stage of the market cycle? We're going to go through delinquency rates of loans in each sector. I love this. I geek out on the debt space. We have an income fund based on real estate debt. So we spend a lot of time on distressed assets and real estate debt. So we're going to go through stage of market cycle, delinquency rates, and the overview of how we got to where we are in each sector. Before we get too far, I'm going to leave this up for 2 seconds while I take a sip of water. This chart right here is the basic outline of that book we saw earlier, Mastering the Market Cycle. This is what it looks like. It's 4 phases. Phase 1, 2, 3, 4. Recovery is kind of that early upswing. Expansion is when it really hits its stride in that asset class. Hypersupply means increasing vacancy. We're on the other side of the equilibrium point. Bad, bad, bad on the downswing. And then recession of that asset class, it's kind of hitting the bottom. Okay. So you can kind of see the drivers on the bottom right of the slide. It's important to note here, every real estate cycle is different per asset class. Sometimes it's a 3-year cycle, 12-year, 20-year. Cycles are different depending on the drivers. So we're going to see that in a moment. We're going to start with single family because it's so newsworthy and it's so damn good in the United States right now. Well, depending on how you look at it. Prices are still going up because supply is down. That's simply put. That is the story of single family, is that we've had rate hikes. We've had huge increases in mortgage costs. Mortgage costs over the last 5 years are up over 120%. Mind blowing, right? Why? Why are they up so much? Meaning, if you're going to pay your mortgage today and you bought a house today or 5 years ago, the increase would be 120% in your monthly payment. How the hell is that possible? Because increases in property values have gone through the roof. That's one. Appreciation of homes is astronomical in the last 5 years. Also, interest rates were at like, what was it? Oh man, I should know this. I think it was 2.6%, 2.7% 5 years ago. Now we're all the way up in the 7% range. Okay. So interest costs have also gone through the roof. On one hand, you can say the single family market in America is broken. There is an absolute case for that because of how unaffordable it is, right? But on the flip side, for homeowners, they are experiencing the best appreciation rates that they've seen potentially in American history. We'll see how far this goes, right? What we're seeing, though, is an interesting crunch here, okay? Because the number one thing that could solve this is building more homes, right? We have a supply problem right now. Nobody wants to sell. So if that's the case, then we're still in an early expansion phase here. We're somewhere in this range. I included this, we included this in this bottom quartile because we're unclear how far this goes. But the reality of single family at this stage is that interest rates are so high, we don't see construction on the horizon. So if nobody's building more homes, supply's not increasing, costs aren't going down. It's not modulating. It's not regulating itself, meaning this looks to continue, not resolve. Okay. So for 2025, what we're expecting is more of the same because we know one thing for certain: construction starts. What the term construction starts means is the permits that people are putting in with their local jurisdiction, counties, cities, etc., applying for permits to start building. Building on average takes 2 years, pretty much every asset class in real estate. So we know what's coming online in 2025 and in 2026 because we know what housing starts look like. You can Google that data, you can stare at it, right? 2025, it looks to be more of the same. If you want to look in a further curve, most people are predicting the same scenario for 2 to 3 years. Others are predicting this for a decade plus because if mortgage rates stay at that 6%-ish range, like we talked about earlier, many people are locked in at 3 to 4%. They can't afford to move. Think about the baby boomer demographic, largest generation in history. About half of the baby boomers have zero plan to move for the rest of their lives. They will live in those houses until the end, right? And why would they? They're locked in at low rates with good payments, okay? So we're going to zoom in on delinquencies. Delinquencies are a spot check on the health of an industry. In July 2022, the single family mortgage delinquency rate was 2.1%. In December 2024, 18 months later, delinquency rate was 1.7%. Out of the 5 asset classes we're going to see today, single family mortgages are the only delinquency rate that actually went down in the last 18 months. Shocking. So, let me pull up a note here. There we go. Okay. It is shocking to say the least. All right. It's a one of a kind asset class to be said for certain. We're going to shift here. I'm bumping over. There we go. Okay. Multifamily, the darling of real estate for, I don't know, 20 plus years, right? Cities love it. Governments love it. Investors love it. For so long, multifamily was the most attractive asset class. Why? I mean, one reason is we've all lived in a home at some point, right? Most of us have lived in a home at some point. So what's an apartment building? It's just a bunch of homes people live in, a bunch of places people live. It makes sense. People can make that jump. It's not like office or industrial that people are less familiar with, maybe, right? The problem is the numbers behind multifamily, there's some concerns in the marketplace right now. What we see, 2024, we only saw 1% rent growth for the whole year. 8% vacancy, property values reduced by between 20 and 25% in different parts of the country. Cap rates 5.6. It's good. They stabilized, thank God, at 5.6. But if you told one of the guys buying at 3 and 3.6, excuse me, 3.6, 3.3 just a few years ago, that in a few years they'd be paying 5.6 for the same property, they'd probably throw up today, to be fair, right? So this is clearly, clearly a rebalancing time for multifamily. This is multifamily really getting back on track. Here's the good news for multifamily. I don't want to paint a super negative picture because it's bigger than that. Multifamily also had in the last year 500 to 600,000 units come online at the same time. So we can sit and talk about 1% rent growth and we could say, wow, that's not very exciting, nothing to write home about. But there's also a 500 to 600,000 unit addition to the marketplace. I mean, all in all, if multifamily can absorb 600,000 units and still have rent growth, it's not so bad. That's not so bad. Here's where I have a concern for multifamily. I'll be honest. We talked about delinquency rates of mortgages in single family homes, July 2022, December 2024. Let's do the same for multifamily. Multifamily in July 2022 had a delinquency rate of 1.4% on mortgages in multifamily. Pretty competitive. That's good, to be clear. In December 2024, 18 months later, multifamily has a current delinquency rate of 12.5%. That is concerning. Roughly 8x increase. There's a lot to sort out there. Now, it's my understanding is the numbers are still just a section, a smaller section of multifamily, but it's concerning to say the least to see that kind of jump, an 8-ish X jump in delinquency rates. Here's a good chart of rent growth, keeping in mind that 5 to 600,000 units came online. I mean, 9.8, that's ridiculous. That's amazing rent growth. That's fantastic. This 1% rent growth really seems to be the stabilized number with that 5 to 600,000 online and being absorbed now. Multifamily is interesting, well, all real estate, but multifamily is particularly regional. Okay, particularly regional. And you can see oversupply in markets like Austin, Phoenix, San Antonio, Raleigh, etc. Those experienced negative rent growth actually. So they were on the lower side. But supply constrained markets, markets that didn't get hit with so much addition, Chicago, Cleveland, Cincinnati, Louisville, they actually saw above average growth. So it's important where you choose your market, just like anything in real estate, but multifamily, overall, it had some hiccups along the way last year. I believe multifamily is near the bottom. In other words, I made my bones early in my career buying distressed assets. Okay. Buying distressed assets. So if I mean, at this stage of Saint's investment career, we buy pretty conservatively. We're not really looking for the best deal. We're looking for the most stabilized long-term investment strategy. That's where we're at this point. But shoot, when I had JV investors and they had a bunch of cash in their pocket and we were at a distressed time in the market, we'd be buying right now. There's a huge upside in multifamily. It's unclear if it's the bottom or if it's just below the bottom or just on the other side of the bottom, but it's near the bottom. You'll never time it perfectly. Any other notes here? Let's see. I mean, huge expense increases in multifamily too. They really just have had a tough couple years since that 9.8%. I mean, really, the last decade of multifamily has just been a grand slam. Last couple years has been the rebalancing. Office. The headline getter, right? Because the numbers are so brutal. We won't drill down into office. Just if you read the news, you're going to see plenty of it. Rents are down and vacancies are up. Simply put, right? This is the pain point right here. 20.4% vacancy rate in Q4 of 2024. The problem is that's not the full picture, and it only gets worse. Okay. 20% vacancy is a sick to your stomach number. The problem is an additional around 15 to 20% on top of that are unoccupied, meaning someone's paying the lease but not even occupying the space, meaning they have no interest in actually going back to that building. We could see very likely in the next couple of years office vacancy hit 30%. There's a lot of projections to that. What I will say here is that there's a long way to go. I think office is uninvestable at this stage. I've never been a fan of office. I got stuck doing a couple deals in office early in my career with my early partners. It's just too tough. Work from home is too much of a question mark, although we see a lot of people going back to office. Return to office, RTO, is a big trend right now. That might save some sectors of office, but it's just uninvestable as far as we're concerned here. So this is basically there's a it appears there's a way to go. Vacancy is not snuffed out here. Increasing vacancy, right? So we're probably around here. This is best case scenario is that we're towards the bottom. Increasing vacancy. We are in a recessionary phase for office, it appears. Let's talk delinquency, right? People not paying their mortgages. From July 2022 to December 2024, 18 months, office had a 3% delinquency rate in July 2022. December 2024, office had a 17.2% delinquency rate. Almost 1/5 of mortgages in the office sector are delinquent. Ouch. Retail. Retail. So retail was one of my early asset classes that we were very involved with. We still have old school parts of our portfolio that retail is still involved. We still have a handful of retail properties, several retail properties. So we're involved in this space. I don't hate retail as much as many headlines make it seem be bad, but I still believe it's uninvestable today. Ours are um, Ours are old school investments. They're very established. They're long-term plays. I wouldn't invest in retail today. Why? Because of the things on this screen specifically. Big retailers are in major trouble. You're not seeing the good numbers. Malls are being repurposed to open air complexes, office, multifamily, mixed use, restaurant, more experiential and more like that 15-minute city game plan. You're starting to see that with a lot of old school 80s, 90s malls. You never saw retail fully bounce back in most regions. In most regions. Now, I do keep in touch with some good friends that are top tier retail brokers. They're showing me where Starbucks triple net 10-year leases are now going for 6 caps. Whereas, a couple years ago, they were going for like 3.5 caps, 4 caps. I mean, guys, that's a huge increase. And you got Starbucks on the lease there. So I do think there's a turning of retail. I think retail has turned the quarter and is on the upswing. I don't believe the drivers of retail are fully in a line. Let me tell you what that means. Unemployment is up. Retail is directly affected by that dramatically. The first thing people aren't buying when they're broke and unemployed is a bunch of knickknack crap at retail stores. That's for sure. We see that drop off very quickly when people's incomes are being affected. So retail is very, very easy to disrupt in bad times. And we are unsure about a lot of a lot of economic things at this time, like unemployment. There's also a question of inflation. How many retailers don't manage inflation well? Even big box retailers, the greedy, evil corporations, their margins, they have, when inflation is rising dramatically, they have hard times even keeping up with maintaining their margins because buyers feel it. You show me when eggs are up 48%, I'm pissed off. I do like my eggs. You know what I mean? And that's the rest of the country too. So retailers are in a tough position right now. Most of the sector has not fully recovered, but I do believe retail's on the upswing here. I believe it's relatively stabilized and will start, on that upswing. The question we never have, or the answer we never really have is how long this upswing is going to look. At what point do we hit that equilibrium and there's a problem? July 2022 delinquency rate for retail was 9.2%. December 2024 retail delinquency rate was 10.9%. So not that big of a jump, surprisingly, right? So it's uncertain, but seems to be stable, is what we would say for retail right now. Still uninvestable, still uninteresting for us, but likely things should get better and not worse. But we're at my favorite, industrial. Industrial. We have saved the best sector for last, unquestionably. There are multiple subsectors of industrial real estate that are arguably the hottest, most interesting, and most upside sectors in all of real estate right now. The reality is, most of these we've already covered bits and pieces of, but there's likely, I mean, we're talking game plans that have decade plus of likely blue skies ahead. The top sectors that we see in industrial real estate are distribution, manufacturing, and data centers. I love specialty real estate. When you understand specialty real estate, you basically have a niche out of a niche. It's very powerful. We've done it several times to great success with our investors. This is a sweet spot for us, industrial. If you look on our website, you will see the majority of deals that we do are in industrial, and we're always really active on the acquisition side. That said, we're also very picky about when we buy. I'll show you the chart and then I'll show you why. Huge warehouses are being built, though. We're seeing a ton of growth. We are seeing industries being revolutionized right now. What we're seeing is that Trump and Biden have focused on manufacturing. We've talked about that. We are also seeing Mexico dethrone China as our number one trade partner. That relationship is extremely important to the U.S. moving forward, is that American-Mexican relationship. We're also seeing changes in warehousing throughout the world. We're seeing that the U.S. right now, remember when we talked about AI? Remember when we talked about robotics growth? The U.S. using AI, automation, robotics, different technologies that the rest of the world doesn't apply as good as the US, we're seeing a 15 to 20x higher warehouse efficiency than average in China, meaning significantly fewer workers needed for the same size warehouse and significantly cheaper management of inventory. If you've ever been in a 200,000 square foot warehouse, you know how important this is. These are warehouses that need golf carts just to get around and take, inventory of different things or check in on different systems along the way. Big, big items to consider. So where is industrial? The numbers all point to industrial still having an extremely long track record ahead. Why do I say that? Let's dive into some numbers. First, 1% vacancy increase in 2024. That's not entirely positive. Nick, why would you be so optimistic about that? Well, because that was really towards the beginning of 2024. What we actually saw is the second half of the year looked to turn around quite a bit and back into positive market territory. On one hand, not great to see the 1%, but on the other hand, if you really drill down into the numbers, similar to multifamily, industrial had the biggest increase of inventory in its history in the United States, meaning more people produced buildings 2 years ago, started development, and brought them to market in the last year or so, 18 months, than we've ever seen in history of the asset class. And we still only had an increase of 1% in vacancy. But here's the good news. Even though vacancy went up slightly, we saw rents increase at 6.9% in industrial over the last year. That's shocking, right? Just in Q4 alone, we saw a 3-cent increase. That's crazy. These are crazy numbers in the midst of the most inventory hitting the market that we've ever seen. So I'm extremely optimistic about industrial, and the numbers show the same. We see a balanced market going into 2025. We see a positive outlook for the industry. We see political support. And we even see, with the construction starts lowering, we can see again about 2 years out, we see that 2025 looks extremely bright, and 2026. Let's go a step further. Mexico, our number one trade partner. Oh, I love this quiz, by the way. Quick quiz highlight. The best real estate sector poll. I am so biased. I'm not even going to answer on this, but please let us know what you believe is the best real estate sector in real estate right now. Man, single family is pretty dang good too, but so I'm a little torn. But this is a great question. We'd like to take your guys' temperature and see where you think the best opportunities lie. But while you guys are filling that out, I'll give you some more information. Mexico, Mexico, Mexico. Our number one trade partner as of 2023. Mexico has overtaken China as our number one source of imports, and they're right next door, which means no shipping problems, which means a close relationship, same continent, etc. So many benefits to that positive relationship. We now have the Mexican president. She has come out and unveiled their tax breaks and their business support for boosting nearshoring and attracting foreign investment to Mexico. Okay. So she's giving these out even to countries near the border on the American side. There's discussions. This is what she said about their strategies. Okay. If North America replaces 10% of the imports we're getting from China, and we then move those to North America, that would boost Mexico's GDP more than 1.2% and the US's GDP 0.8% more per year. Huge GDP boosts by bringing those manufacturing opportunities back to North America. So we're staring at this model here. We can see we went through some of the numbers. Let's talk about what the drivers are of industrial so we understand why the best parts of industrial are thriving right now. Number one is going to be major port access. Still in the United States, we import a ton from overseas. You're still going to see China, which is the manufacturer of the world. It still is. Southeast Asia, tons of manufacturing, tons of specialty manufacturing. So port access for industrial is extremely important. Number two is major organized distribution networks. Okay. You have to bring supplies into a region that can spread it out throughout the United States. Okay. You have to have the infrastructure. You have to have the roads. You have to have the bridges. You have to have the hubs for all the trucking, et cetera. The third, it's close to Mexico. It really is. The southern US is disproportionately benefiting from the industrial boom in the United States. So what are our top three markets for industrial in 2025? Number one is going to be the Texas Triangle. Okay. That is Dallas, Houston, San Antonio, and Austin, right in the middle of that triangle. Why? For exactly the reasons we just said. Houston is the port. It brings in tons and tons of imports to the US. That region is also southern US. It's on the eastern, southeastern border with Mexico. So it has the imports through the port of Houston. It brings goods and services up from Mexico, our number one trade partner in the world. And it has an amazing distribution network. Basically, Texas can supply a huge chunk of the United States, 30 to 40% of the United States alone. It can go up towards the middle. It can spread out on the coasts, mostly eastern, right? It bumps mostly eastern. So number two. So number one, Texas Triangle. Absolutely 100%. Okay, I'm gonna say something. I'm gonna let you guys in on a little secret for 2025. We're planning on a syndication. We're planning to bring a industrial deal to our investment community. So if you're interested, I would book a call with Luke on the calendar. I'd get a call on the calendar and check in and learn more about what might be going on the industrial side for us in 2025 because we're feeling the timing is right for the market. We've been waiting 2 years for the timing of this market to be perfect to where we are seeing the positive impacts there. So it's likely going to be in Texas. Secretly, I want 2 deals next year, or this year, excuse me. I want 2 deals in 2025. But definitely one will be coming online later this year. Tax benefits, cash flow, a great deal, et cetera. I'm really excited to show you guys what we're looking at. Number one, Texas Triangle, best market for 2025. Number two, Inland Empire, Southern California. For all the headaches of California and doing business in California, California also sits in essentially the perfect place for industrial in so many ways. You have the ports of Long Beach and the ports of Los Angeles. Any given year, that's about 30 to 40% of US imports, primarily from Asia. That's one of the premier Asian ports to import from. You also have you also have Los Angeles, you have Orange County, you have San Diego, and they all converge on the Inland Empire, which are the Riverside and San Bernardino counties. That's where all the goods go. and then they spread out on the western and southwestern US. I still love the Inland Empire, Southern California, for our number two region. Number three in 2025 is Atlanta. It has the port of Savannah, not that far away. It has great access to the eastern, northeastern part of the US for distribution, and it's still a massive hub of consumption. So Atlanta's number three, but it's a distant number three, to be fair. That would not be our first choice. Texas is a big focal point for us. So all that said, first off, why did we wait 2 years to start looking at deals and to find the right time for industrial? Well, one, we have an amazing income fund, and that seemed to be a perfect fit for our most sophisticated investors. So it was a good opportunity. We wanted to make sure we were supporting our investors when they needed it. But number two is timing in industrial is extremely important. Why? Because the industrial we look at, especially warehouses and manufacturing, have one tenant, meaning one tenant pays 100% of the rent. So you're either 100% occupied or 0% occupied. That's a good thing because oftentimes you have a multinational company that occupies that space. The downside is if you invest at the wrong time and get a tenant at the wrong cycle of the market, you're dealing with 5 years of below market rents. Okay. Hard discussion to have with your investors. So timing in industrial is important. What we want to see in industrial is when the market is on the downswing, you're not investing. You're not trying to time the bottom in industrial. You're waiting for the positive indicators and the upswing firmly. We believe we're there. In the markets we're looking at, we are very confident that we're seeing those trends now. So delinquency rates. Let's talk mortgages in industrial so we know if it's strong or not. In July 2022, industrial had a delinquency rate of 0.2%. I mean, that blows me away. 0.2% delinquency in July 2022. 18 months later, delinquency rate is 0.8%. You are at sub 1% of delinquency in industrial. So even with the turbulence of the last 2 years for all of real estate, industrial is still sub 1% delinquency. This is such a good indicator. It's so much confidence that it gives you. So I love industrial. If you want to learn more, book some time with Luke to get some more information. Let's shift gears. We're going to jump into stocks. We're going to do a brief overview of what that market looks like. In general, we see the economy, especially when it overlays with stocks, in a little bit of a shaky area. We see that the current good times in the stock market, which have been, almost too good, can come to a screeching halt at any moment. We get news from China like the other day. You see Nvidia drop 14%, right? If you recall, we had days throughout 2024 where randomly we saw drops 9%. Right? Huge, huge losses in big, big companies. There's turbulence in the stock market built in. Today, since 1995 to today, we've lost 40% of the number of companies in the New York Stock Exchange. Your diversification is less in those markets. So, simply put, it's likely that a recession will come at some point. If you look at the data points, we know that there are bad storms brewing in different sectors. The question is where, and the question is why. We also have a poll. Love for you guys to give feedback and give your vote. How worried are you about the stock market? Let us know. This is very important for how we understand where you guys see the market conditions. Maybe I'll scare you a little bit. I hope not. I don't know. That's not the intention, but we're going to go through some scary charts. Okay. First things first. Treasury yield inversion. So when the yield curve inversion, or when the yield curve inverts, which we see here, this usually, typically, more often than not, indicates a looming recession. So you can see that. You can see where the crashes are indicated. You can see where the gray area shows the recession and how long it lands or how long it goes for. And you can see when the yield curve inverts. And then we see where we're at today. The likelihood is a crash coming at some point in the near future. All right, unemployment, another way that we can spot check on recession. Anytime the unemployment rate moves below its 36-month moving average, which is the blue line, it typically marks the start of a recession. That's today, guys. That's right now. So now we have two indicators that are showing us recessionary likelihood. Not amazing, not super positive. And number three, we see the federal funds target rate. So we see that the federal funds rate, when the Fed raises interest rates to slow down inflation, then they pause interest rates after the inflation starts to show. They begin to lower interest rates. Again, we start to see this cycle repeat itself. Okay. So just a few other spot checks here, a few other spot checks just to paint the picture. Berkshire Hathaway, Uncle Warren, Warren Buffett, Hall of Fame investor. Man, he has been selling off. He has been selling off to the point where he's sitting on record cash. The indicator typically when you see sell-offs by Warren Buffett, right? Like let's kind of, 2008. Then he deploys cash when the market's bad. He starts to sell off and redeploy. And all of a sudden we're seeing record cash held by Warren. So this one's a little scary. Okay. Maybe Warren's wrong. He can be wrong too, right? But this one makes me sick. Corporate executives in the Fortune 500 companies have been selling off their stocks at record highs. We have never seen this rate of sell-off by corporate Fortune 500 executives. I don't know. I don't want to throw around terms like insider trading. That's not what I'm saying here, but they know something that most of us don't about their companies. They're going to see that more. So if they're selling off their stocks, that gives me a little bit of a red flag. And S&P 500, we see some bubble territory, right? We see a bubble here, we see a bubble here, and then we also see where we're at today. Massive, massive increases. All right, so we've attacked this from a few different angles, right? We see some different ways to look at a potential burst bubble, especially in the stock market. The reality is, no matter what anyone says, we don't know exactly what will happen or why or how until we see it. But we can all remember Lehman Brothers. Do you remember where you were when Lehman Brothers fell? Right? Do you remember? I remember where I was. I remember reading the newspaper article and being shocked. Remember newspapers, right? That's how long ago Lehman Brothers is when newspapers were the ones breaking news about things like a collapse of a financial behemoth. I mean, an institution in the United States. Here's the point. If you're in stocks, I own stocks too, right? The moral of the story here is that we have seen the trends. We just went over some of the biggest trends, the biggest numbers in every market segment, really, of the American economy. There are huge opportunities right now. Stocks may not be the one, but that's totally up to you. The number one consideration is how diversified are you? We know inflation is back on the rise. We know that rates have highs and lows here. Most importantly, it's about how diversified are you? What we see as the most sophisticated advanced investors, what they're doing is moving into hard assets. We are seeing real estate taking on a massive focus right now. You have seen the performance. The sectors that are killing it are taking on a disproportionate investment amount. So consider, if you feel like there's a rocky stock market, which is 6 out of, or what is it? Vast majority of the voters have some degree of a concern here, and about half are moderately or very worried about the stock market. Hard assets is the name of the game right now. Absolutely. So this would be looking at a balance of diversification, performance. Let's see. Right here. So this is our all-weather portfolio. This is what we are seeing our best investors, the best discussions we're having. These are the ones we're having with bank CEOs. These are the ones we're having with the biggest fund managers that we're working with, etc. It's balancing an all-weather portfolio. In this market, what we are seeing is fixed income and growth as the perfect harmony portfolio, the all-weather portfolio. That means if the market goes down, you are getting your fixed income on a monthly basis. You're getting paid every month. You can count on what percent return you're getting. It's not market driven. It's not stock driven. China's not going to release some new product that's going to tank the stocks that you own by 14% in one day. It's fixed income. And the other side is growth. You got to have some growth, right? You got to have some upside potential. But we're saying that the most advanced people we're seeing are tying their growth to fixed assets, to real assets, real estate, because inflation boosts real estate typically disproportionately. Rent growth in real estate is beyond inflation most of the time. Appreciation in real estate is often beyond inflation. So it's a hedge, it's a strong hedge. And right now we're seeing that as the absolute best combination. So if you're looking for an opportunity, or if you're looking for opportunity for fixed income, the best opportunity that we're seeing is an income fund. Candidly, we are one of the options. I mean, Saint is my favorite option in the marketplace. And, I just put about 100 grand in within the last handful of months. That's not because I don't know the market. That's because I do know the market. Okay. I'm not seeing other funds that are diversifying or having strategies like we are. And frankly, I looked around to try to find a competitor that I liked better, and I didn't find it. So we're looking at investments, 10, 20, 30 years. We're looking at mortgages in the United States. So it's a long-term perspective. We're not looking at short-term market trends, but long-term trends, and we're looking for fixed income on our side. The number one opportunity, whether you go with us or somebody else, we urge you to take a look at single family mortgages as the driver of the fixed income, because they have that multi-decade approach. And because, as you saw, single family is such a freaking outlier. It outperforms everything right now. And there's no end in sight to the lack of supply. There's no end in sight, it appears, to the increasing appreciation. So take a look at single family mortgages. If you're looking at fixed income, we're happy to send you more information about what we're doing as well. Why do I like mortgages? Why do I like mortgages? Why do I believe that mortgages are the all-weather fixed income opportunity right now? Is because they're stable. So let's say rates go up, which is what we've been seeing. We're at about 7% today. If rates go up, a mortgage portfolio is actually more stable. Why? Because you're going to see less refinances. Because if your whole portfolio averages 3, 4, 5% on their rates, what's the alternative? They refinance and get a 7%, or they sell their house and then go move to a 7% rate? You just don't really see that. People are smart enough to know that they don't want to pay an increase of 120% on their mortgage payment. They're pretty comfortable where they are. So less refinances, less turnover in the portfolio. So that gives cash flow more stabilized for us as the portfolio managers. And just overall less turnover is less rigmarole, where we can pay consistent payments for decade plus. And on the flip side, I mean, the obvious question is, what if rates go down? Because that's what the Federal Reserve is saying. Hey, okay, we're not going to go down that full 1%, but we might go down 0.5% over the next year. We're fine with that. We're completely comfortable with that. Why? Is because as rates go down, it stimulates buying, which boosts the value of the underlying assets, right? The homes. That means more equity for the borrowers. We are rooting for people to have more equity because they are more secured. Our investments are more secured in those properties, right? It also stimulates our returns. The reality is, if more people, let's say they go out and they sell their house and they go buy a new house, our returns go up if they pay early. We're happy with that, right? All we do on our side, if somebody refinances or sells or, cashes us out as the mortgage holders, we just go buy mortgages. We buy more mortgages and grow the portfolio with those good returns. So when I say all weather, I mean it. I mean, if rates go up, if rates go down, we're still dealing with the most entrenched, rock solid asset class from what the numbers are showing that we just went through, single family mortgages. So all in all, we really truly are seeing this as the best opportunity in the marketplace. If you want to learn more, here's where you go. There's a QR code that you could take a picture of, and it'll take you directly to booking a call, or you can text wealth to 949-787-0957. We will drill down. We'll customize the call to your needs, to your portfolio, to what you're looking at. You got Luke on the other end, an amazing investor success professional. He's been crushing it and is really, really good at finding the best solution for our investors. And then also, we're mostly done with the content here, but our YouTube channel has the expanded version of this. Every webinar that we do, we have to chunk down to make a smaller, condensed, ultra condensed version of the content. If you want the expanded discussion where we really do dig into charts deeply and go line by line on all this, check out our YouTube channel. Our long form, we have the Great Melt Up, which we released last month, was fantastic. That's about government spending and debt, the problems that we see on the horizon, the debt bubble that we're in with the government, how you can invest during that. Most importantly, we have some demographic analysis of the baby boomers and $72 trillion that's being passed into the economy over the next decade plus. I mean, tons and tons of good information there. I'd highly encourage our YouTube channel for you to check out.